Apart from the massive human toll, the Ukraine-Russia crisis has shed a significant light on the economic problems of using oil and gas to power our lives. Not only are there severe economic impacts of sourcing and burning fossil fuels, but now there's a big supply risk since only a handful of countries in the entire world actually export crude oil effectively. And one of those exporters is unfortunately Russia. But as many climate experts and engineers have predicted, technologies like green hydrogen and fuel cells can actually give us the critical opportunity to completely decentralize our energy production. And this will help us reduce our dependence on big nations like Russia to supply us crude oil to make our natural gas, heat our homes, and power our cars. And by far the unarguable leader in this entire industry right now is Plug Power, trading under the ticker symbol PLUG, which just released its full year 2021 earnings report that gave us invaluable insight into how quickly this company can grow and reach profitability over the next few years. And so in this video, I'll be giving you guys a summary of Plug Power's latest earnings report, analyze their valuation, and at the end, I'll analyze the stock chart to share the prices that I am personally buying the dip on. But before we get into it, guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. Let's start off by analyzing Plug Power's shareholder letter, where they reported revenue of around $502 million in 2021, with $162 million of that coming in the fourth quarter. And unsurprisingly, this is actually a record year for Plug Power, which means that this company is growing at a very high rate and the management team is undoubtedly executing at a very high level, which obviously means that this company is going to be trading at a pretty expensive valuation compared to some of the other fuel cell and hydrogen stocks. And this is where I'm seeing a lot of confusion in the investor community, because people are looking at the analyst estimates, which is the fact that Plug Power reported a net loss of around 33 cents, which obviously does not meet the analyst estimates of around 11 cents a share. But the thing that people are missing is that Plug Power is a growth stock, meaning that analysts should really be focusing on the revenue growth opportunity for this company. And as you guys can see, revenue did indeed beat analyst estimates, which is exactly what I think retail investors should be focusing on for this company. And if you actually dig into the letter, there are some pretty clear reasons as to why Plug ended up missing analyst estimates and reported a wider than expected loss. As you guys can see, the first reason is the fact that Plug Power ended up incurring a $56 million non-cash charge for the fourth quarter, which essentially dealt with the servicing of their legacy fleet through the remainder of their service contracts. And that should have definitely helped boost this company's EPS and potentially reduce the margin from analyst estimates. And the second big reason they mention is the fact that their margins have been a little bit under pressure right now, particularly in their fuel business, which is where they're essentially selling hydrogen to companies that require it. As we all know, hydrogen is used in a lot of different industries, from steel, manufacturing, glass, and ammonia. And so Plug Power is acting as a big beneficiary of that entire boom. And once their green hydrogen business comes online, their costs will come down significantly. But obviously for the short term, increased gas prices have significantly increased the cost of natural gas that these guys use to make that hydrogen in the first place. And obviously since their Tennessee plant for green hydrogen only came online a few months ago, that means that their costs from that particular plant are going to be very high. And obviously, since the demand for hydrogen is going to be increasing at a very rapid rate over the next decade or so, Plug Power really is in the front seat to take advantage of this and experience a lot of margin compression as they scale up these plants and build more efficiencies as to how they deliver the green hydrogen to their customers. And as can be seen by the study through the IEA, which is the International Energy Association, the demand for green hydrogen is expected to increase substantially, not only in the industrial segments, but also in the grid injection and the power and ammonia sections. And since obviously Plug Power has a very big electrolyzer business that is growing in the triple-digit rates right now, this company is at the forefront of taking advantage of this demand, not only in North America, but obviously in Europe. And for those who don't know, an electrolyzer is essentially a device that converts electricity into hydrogen fuel without any combustion or any carbon emissions. All you need is some water and some electricity, and you can basically produce hydrogen for free. And that significantly reduces carbon emissions because you don't need to dig out natural gas from the ground, produce all this oil, and create all these shaling facilities to actually make the hydrogen that we need today. And as can be seen through the multiple projects that Plug Power has won throughout the past couple of years through their electrolyzer business, this company is going to be at the forefront of this technology adoption, and as a result should be growing at very high rates in revenue over the next couple of years. Now obviously the big question on everybody's mind is, why has Plug Power stock not reacted all that much in after hours, even though the earnings report seems so well on the surface? And I think the reason for that is pretty simple, and that's the fact that we did not see any major surprises in this earnings report, and generally speaking, this company is executing at the level that most of Wall Street has expected them to. And I don't know about you guys, but for me, that is a great thing because that means that this company is essentially executing at a level that most investors are very comfortable at. And obviously, since this company is expecting incredible revenue growth over the next couple of years, well in excess of 60 to 70%, then that is a very good thing because that means that this company is executing on its plan, and all the hype that a lot of people had priced into the stock in 2020 is actually going to pay off. And unlike a lot of other clean energy stocks, Plug Power actually has the right tools to actually execute on their business plan and grow revenue aggressively. As you guys can see, they have around $2.5 billion in cash sitting in the bank as of the end of last year, and essentially no debt on the balance sheet of around $1.3 billion. And so Plug can basically pay off all its debts and still have around $1.5 billion in cash on hand to execute on its growth plan. And since obviously the stock is trading at around a $15 billion market cap, that is an insane amount of cash this company has compared to where the stock is actually trading at. And so if you're looking at the stock from a growth or a value perspective, then this company is not that big of a risk if you're investing in the stock right now. And that should definitely add to the amount of analysts and investors and hedge funds that own this stock over the next couple of years. And the best part is this company has already announced a lot of partnerships and joint ventures over the past year or so, as can be seen through their Hyvia partnership for fuel cell trucks in Europe, their green hydrogen supply and distribution partnership with Certarus, and their massive green hydrogen production partnership in Europe with a company called Life. What all these partnerships allow Plug Power to do is to vertically integrate every single step of their entire hydrogen business, from the creation of hydrogen to the usage and the logistics of hydrogen. And as many analysts have already predicted, this is going to create a very strong flywheel effect where a lot of the hydrogen that Plug Power is making themselves can be sent into fuel cell applications that Plug Power is also developing the hardware for. And obviously, as we know, fuel cells have a massive application in heavy duty industries like trucking, airplane, and obviously shipping, which is exactly where the ProGen engine platform for Plug Power is going to come in as a major advantage for all these different industries to help them decarbonize. And obviously Plug Power's partnership with Renault in the Hyvia joint venture is only going to increase the total addressable market for Plug Power. And with the amount of cash these guys have on hand, they're definitely going to be able to sell a lot of these trucks going into 2022. And so now that we have an idea of the big updates that Plug Power addressed in the earnings report, let's address the big question in the room, which is whether or not this stock is expensive or cheap right now. As you guys can see, this company is actually accelerating its revenue growth, which means that this company is on track to get around 80% year-over-year revenue for 2022, which is a pretty significant bump from around 47% last year. And so if you actually do the math and calculate the price to sales ratio for this company, which is at around 32 right now, in 2022, the price to sales for this company is only going to be at around $15.50. And that is obviously with the $900 million estimate that they gave us for 2022 revenue. And if you take into account that this company is obviously growing at around 80%, that is actually a very, very cheap price to sales ratio in my opinion. And if you actually go out to 2025 and take their 17% operating income margin, then the forward price to earnings ratio you're paying on this company is at around 35 to 40 bucks. And obviously the earnings ratio is for 2025 and not 2022, since this company is not expected to be profitable in 2022. And if you take into account the fact that this company has been in business for around 20 years and that this company is actually founder-led by its CEO, Andy Marsh, then the risk you're taking investing in a growth stock like Plug Power is actually very low as compared to a lot of the other pre-revenue and early-stage growth companies in the hydrogen and EV space. And as for what prices I'm personally buying Plug Power shares at, I think anything under $28 to $30 is a very good deal on this company right now, because obviously the stock has pulled back significantly from its highs of around 70 bucks back in 2021. As for the short term, we formed this very nice double bottom around the $16 region, which means that if we break above this resistance level with a lot of volume, then this stock can definitely go back to that $30 range very fast, which is actually the price the stock was at back in December. But anyways guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below how many shares of Plug Power do you own and whether or not you're buying the stock right now and what is your long-term price target. But anyways guys, I hope you enjoyed this video and I'll catch you guys in the next one. Take care.